I'm your host Zayed Haji, founder of Islamic Finance Research, Islamic Studies Research and the Islamic Guidance Council, and in today's episode we dive into the IMF's latest World Economic Outlook to uncover what it really means for your livelihood, your community and the Amana Almighty has given us. Before you scroll past or tune out, ask yourself a simple question. What if the next price hike at your grocery store, the next sudden rise in loan rates, or the next drop in demand for your work isn't random at all, but the direct result of decisions being made in other countries right now? Because that's exactly what this IMF report is warning us about. The world economy is still moving, but it's burning tomorrow's fuel to keep today alive. If we ignore those signs, we'll wake up to higher prices, fewer opportunities, and no idea where it came from. If we pay attention, we can demand real reform before the storm arrives. Stay with me till the end of this episode because what I'm about to share is not economics. It's a map of your and mine future. You might wonder why anyone outside a government office or a Wall Street trading desk should care about a table filled with numbers and country names. The answer is simple and direct. Because what happens in those countries decides how much your food will cost, whether interest rates on your loans will go up, and whether your job or business will still have demand next year. The IMF World Economic Outlook Update July 25 reads like a quiet warning, not shouted, not exaggerated, but deeply serious. It tells us that the world economy is still moving forward, yet the fuel driving it is running low, and in many places, it is being burned in advance before new shocks arrive. Let's walk through the landscape of 2025 the way the IMF shows it. World output. Global economic growth is projected at 3% in 2025 and 3.1% in 2026, lower than before the pandemic and lower than 2024. The recovery continues but at a weakening pace. Advanced economies are slowing down as a group from 1.8% growth in 2024 to 1.5% in 2025 and 1.6% in 2026. United States growth projection slows to 1.9% in 2025 and 2% in 2026. The economy is still expanding, but much of that strength comes from front-loaded spending and investment before new tariffs kick in, not from organic consumer demand. In the euro area, growth projections hits 1% in 2025 and 1.2% in 2026. Inside that group, Germany barely grows 0.1% in 2025, 0.9% in 2026. France grows at 0.6% and 1%. Italy moves only slightly 0.5% and 0.8%. Spain slows down from 2.5% in 2024 to 1.8% in 2025, then 1.6% in 2026. Japan weakens further, growing 0.7% in 2025 and 0.5% in 2026. United Kingdom reaches 1.2% in 2025 and 1.4% in 2026. Canada grows 1.6% in 2025 and 1.9% in 2026. The IMF groups smaller rich countries such as Australia, Korea, Singapore, etc. into other advanced economies. Together they grow at 1.6% in 2025 and 2.1% in 2026, still below pre-pandemic levels. Stay with me till the end because this isn't economics. It's about safeguarding our collective future. Emerging market and developing economies still carry the global economy's momentum. Even though their growth is also slowing, they project to grow 4.1% in 2025 and 4% in 2026. In this group, emerging and developing Asia remains the strongest region overall, growing projections to 5.1% in 2025, 4.7% in 2026. China projections rises to 4.8% in 2025, then slips to 4.2% in 2026. India keeps a strong projection of 6.4% pace in both 2025 and 2026 emerging and developing Europe slows to 1.8% in 2025 and 2.2% in 2026. Within that group, Russia will drop to 0.9% in 2025 and 1% in 2026. Latin America and the Caribbean slow to 2.2% in 2025, recovering slightly to 2.4% in 2026. Brazil moves from 2.3% to 2.1%. Mexico improves from 0.2% to 1.4%. After a sharp slowdown in 2024, Middle East and Central Asia grow 3.4% in 2025 and 3.5% in 2026. Saudi Arabia improves to 3.6% in 2025 and 3.9% in 2026. Sub-Saharan Africa holds at 4% in 2025, rising to 4.3% in 2026. Nigeria moves to 3.4% in 2025 and 2% in 2026. South Africa remains weak at 1% in 2025 and 1.3% in 2026. As a broader view, emerging market and middle-income economies projection grow 4% in 2025 and 3.9% in 2026. Low-income developing countries perform better at 4.4% in 2025 and 5% in 2026, but starting from much lower income levels. Note: these are projections, which means they are forward-looking estimates based on today's data and assumptions. They are not guarantees but educated forecasts used to prepare for what is likely to happen. You might also wonder why developed countries have lower growth rates than developing ones. The reason is simple: their economies are already large and mature. It's much harder for a $25 trillion economy like the United States to grow by 6% than it is for a smaller, rapidly expanding economy like India or Nigeria. Developing countries still have room to build new infrastructure, industries, and markets, so even a small improvement creates higher growth in percentage terms. In other words, the bigger the economy, the slower it tends to grow, and that's why developing nations often show higher growth rates than rich, advanced ones. Now, why does this matter to someone who is not an economist? Because behind every number in that list is a chain reaction that directly impacts your everyday life. Stay with me till the end, because this isn't economics. It's about safeguarding our collective future. If the United States and Europe slow down, demand for goods and services globally falls, which reduces opportunities and income in exporting countries. When China's growth declines, global supply chains become tighter, which raises prices and delays deliveries everywhere. If India and other fast-growing nations hold steady, they become key anchors of global demand. But if they start to slow, there is no backup engine left to pull the world along. Each country's slowdown means fewer jobs, higher risk for businesses, and more pressure on governments to borrow. And that borrowing eventually leads to higher taxes and interest rates. So the real story is not just the world is growing. The real story is that the growth is coming from early moves made to avoid future shocks, and those shocks haven't gone away. They are simply waiting ahead in the form of new tariffs, worsening geopolitical tensions, high public debt, and delayed structural reforms. That is why this matters to you, because the prices you face in the supermarket, the opportunities you have for work or investment, and the value of the money you save all depend on whether the global economy remains stable or slides into another cycle of fragmentation and uncertainty. If people understand this early, they can demand clarity, support real reforms, and push for cooperation over short-term politics. If they don't, they will feel the consequences without ever seeing them coming. This is not about numbers on a page. It is about whether tomorrow will still offer more opportunity than today. Before you switch off, ask yourself one thing: what if the next rise in your daily expenses isn't just bad luck, but the direct consequence of decisions being made in other countries right now? The IMF is warning that the world economy is running on borrowed strength, using tomorrow's resources to survive today. If we ignore that, we're choosing higher prices, fewer opportunities, and deeper uncertainty. If we pay attention, we can call for honest reform and protect what's still left. Stay with me till the end because this isn't economics, it's about safeguarding our collective future. You might be thinking, all these percentages and forecasts, where do they even come from? And why should someone like me, living far away from government offices or financial markets, care about them? GDP basically answers one question: how much did a country produce this year? To calculate it, economists use a very simple formula. GDP is equal to C plus I plus G plus X minus M, and I know that looks scary, but it's just shorthand. C stands for consumption, what people spend, food, clothes, fuel, phone bills. I stands for investment, what businesses spend to grow machines, tools, factories. G stands for government spending, roads, schools, hospitals, defense, etc. X stands for exports, goods we sell to other countries. M stands for imports, goods we buy from other countries. So X minus M simply means exports minus imports. If we export more than we import, it adds to GDP. If we import more than we export, it actually reduces GDP, that's it. And once this total GDP number is calculated for 1 year, they compare it with last year and use a little percentage formula, GDP growth, percentage equal to this year's GDP minus last year's GDP divided by last year's GDP multiplied by 100. If the result is plus 3%, it means the country produced 3% more than last year. If it's minus 1%, it means production actually fell by 1%. That's where all those 3% growth or 2.1% growth numbers come from. Nothing fancy, just one big plus and minus calculation on how much the country produced compared to the year before. So let's ground the story in something real. Imagine a poor farmer in our village. He owns a small piece of land, grows wheat and sells it in the local market. He has no stocks, no savings account, no loans. He doesn't watch the news about interest rates. But one day the fertilizer he normally buys suddenly becomes more expensive. The tractor owner who plows his field wants to charge more. The middleman who buys his wheat pays a little less. Nothing terrible happens in one morning, but the farmer can feel something shifting. What changed? None of his farming practices, but the world around him did. This is exactly why the IMF publishes the World Economic Outlook. Those percentage figures are not random, they are measurements of how fast the global economy is expanding or slowing. The IMF collects data from every country, combines GDP, the value of all goods and services produced, and then uses that information to project where things are heading. Before you scroll past, think about this: that rise in food prices, that extra rupee you pay for fuel, it's not random. It's the result of decisions made across the world. And Allah is reminding us through these economic shifts that tomorrow's provision is being used today. If we ignore this warning, prices will rise and opportunities will shrink. If we pay attention and demand fairness, reform and cooperation, we protect the risk Allah has placed in our hands. Stay with me, this isn't just economics. It's about your livelihood and our responsibility before Allah. When the report says global growth will be 3% in 2025, it means that the total value of economic activity in the world is expected to grow 3% larger than it was the year before. Now here's what that means for the village farmer. If growth is strong and stable, rich countries import more food. That pushes up global grain prices. Even a small farmer in a remote village eventually receives a better price because demand is high. But if growth slows and countries raise tariffs, extra taxes on imports, then trade becomes more expensive, demand falls, and prices drop at the farmer's gate. If inflation in the United States or Europe rises, their central banks raise interest rates. That makes it harder for investors in those countries to invest in emerging markets, including agriculture projects and infrastructure in developing countries. High global inflation also raises the cost of fertilizer, diesel, seeds, and pesticides. These input prices move globally because they are produced and traded across borders. This is why the IMF warns that the current growth, 3% in 2025, 3.1% in 2026, is fragile. Not because the numbers look small, but because the engine behind them is unhealthy. Companies are rushing to import and invest now, simply because they fear tariffs will rise later. This is called front-loading. It creates the illusion of strong activity, but it actually steals demand from the future. Like a farmer harvesting before the crops are fully grown, yes, there is produce today but less left to harvest tomorrow. That is why even though growth looks acceptable, the IMF is clear that the United States is heading into slower consumer demand 9% to 2% growth. The euro area is growing mostly because of one-off X spikes 1% to 1.2%. Japan is nearly flat. China gains short-term momentum from lower tariffs, but this is not sustainable. India is still growing strongly at 6.4%, which is encouraging but cannot carry the world alone. At the same time, global trade volume in 2025 will rise plus 0.9% because countries are buying early, and then fall in 2026 minus 0.6% when that early buying stops. And then come the risks. Tariffs could be reimposed overnight, raising prices of everything from diesel to machinery. War in the Middle East could raise oil prices. Even the farmer in the village pays more for diesel and transport. High public debt in rich countries could trigger financial panic and push interest rates higher. That makes it more costly for your own government to borrow for irrigation, roads, and subsidies. Inventory piles could start a wave of cancellations and bankruptcies in the supply chain, including for agricultural inputs. If nothing else goes wrong, the world will still be slowing down. But if even one of those risks strikes, then the tightrope breaks. Stay with me till the end, because what looks like global economics is actually a warning about your own livelihood and an amana from Allah. Which brings us to the most powerful point of the entire IMF report. Either nations cooperate, reform, and build clear trade rules, or they retreat into protectionism and unleash a new wave of inflation and stagnation. Trade agreements, digital platforms, labor market reforms, and targeted industrial policies can still create stability, jobs, and predictable prices. But delays, uncertainty, and fragmented decisions will push the world into higher prices, fewer opportunities, and unstable currencies, and even the farmer in the village will end up paying the price. That is why these numbers matter. They are not just statistics, they are an early warning system. They tell you whether the world will remain fertile, like a field after good rainfall, or whether the soil is quietly drying out. And right now the message is unmistakable. The world is still standing, but only because we borrowed strength from tomorrow. If real cooperation and reform do not happen now, tomorrow will arrive empty-handed. The farmer may never read the report, but the decisions made in response to it will decide what his next harvest is worth. That is why this is not a technical report. It is a map of your and mine future, and the time to pay attention is before the storm arrives. Before you tune out, remember, when nations consume today what belongs to tomorrow. Allah sends warnings, and this IMF report is one of them. Ignoring it leads to hardship and injustice. Listening to it allows us to reform, cooperate, and protect the risk Allah has entrusted to us. Stay with me, because this is not economics. It's an amana. From an Islamic perspective, economic conditions are not merely numbers or market cycles. They are tests, signs, and reminders given by Allah. The Quran repeatedly teaches that wealth, trade, prosperity, and hardship are all part of a greater divine system, and that the believers must interpret these changes through the lens of tawakkul, trust in Allah, accountability, and collective responsibility. Allah says, "It is He who gives abundance or restricts provision to whom He wills." Quran 42 chapter verse 12. This means that global growth, inflation, slowdown, or prosperity are not neutral natural forces. They occur by the decree of Allah, and they serve a purpose. When the IMF warns that the global economy is being artificially supported and that current consumption is being borrowed from the future, a believer should immediately recognize a profound parallel in the Quranic message. When nations exhaust their resources in greed and ignore justice and moderation, the result is eventual decline. Allah warns in Surah Al-Isra chapter 17 verse 26 and 27, "And give the relative his right, and also the poor and the traveler, and do not spend wastefully. Indeed, the wasteful are brothers of the devils, and ever has Satan been to his Lord ungrateful." Most of the growth described in the report is not driven by real, balanced need. It is driven by fear, speculation, and front-loading consumption. Islam teaches that such behavior leads to instability and injustice because it breaks the equilibrium, mizan, that Allah placed in the earth. Another important Islamic lesson is interdependence. The Prophet, peace be upon him, said in Sahih al-Bukhari hadith number 6011, narrated by Nu'man bin Bashir, Allah's Messenger, peace be upon him, said, "You see the believers as regards their being merciful among themselves and showing love among themselves and being kind, resembling one body, so that if any part of the body is not well, then the whole body shares the sleeplessness, insomnia, and fever with it." The same is true with nations in the global economy. When China slows down, Africa feels it. When Europe faces inflation, the farmer in a poor village pays more for basic inputs. This connectedness is exactly what Islam wants the Ummah and the wider creation to recognize, so that we respond with solidarity, justice, and cooperation, not with selfish protectionism or exploitative policies. The IMF says either nations cooperate and reform, or they retreat into isolation and bring about instability. Islam teaches the same principle with one additional layer: cooperation must be upon truth and justice, Quran chapter 5 verse 2. And cooperate in righteousness and piety, but do not cooperate in sin and aggression. Finally, the believer should see this situation as a moral warning. The system appears stable now, but only because, as the report says, we have borrowed strength from tomorrow. That is the exact definition of gurur, delusion, in the Quran, where people assume that temporary comfort means long-term safety. Surah Luqman, Quran chapter 31, verse 33. O mankind, fear your Lord and fear a day when no father will avail his son, nor will a son avail his father at all. Indeed, the promise of Allah is truth. So let not the worldly life delude you, and be not deceived about Allah by the deceiver, that is Satan. If leaders refuse to reform Islam, if nations continue to create artificial barriers, tariffs, to increase debt, and to allow injustice in trade, the result will not be long-term prosperity. It will be imbalance and eventual collapse, as every previous unjust civilization witnessed. In this moment, the Islamic perspective is clear. Recognize that economic changes are part of Allah's decree. Avoid excess, waste, and artificial speculation. Demand justice and fairness in trade and policy. Cooperate globally upon truth, not exploitation. Prepare for the future by acting ethically today. And most importantly, return to Allah with humility, because real stability, provision, and prosperity come only from Him. If today's discussion opened your eyes even a little to how global economics shapes your daily life, don't stop here. Get The Invisible Debt Trap on Google Play Books, Amazon Kindle, or in paperback, and dive deeper into the principles that protect you from the next financial shock. Visit zayedhaji.com and zayedalhaji.com for more resources and upcoming episodes. This is Zayed Haji signing off. Stay aware, stay grounded, and never forget that even global economics becomes a matter of responsibility when viewed through the lens of faith.